let me introduce myself because I'm a little bit new, so less and less new by the day. But my name is Matt Gammans. I'm an assistant professor in the Department of Agribusiness and Applied Economics. I've been at North Dakota State about 1 year now. My appointment is a little bit different. It's primarily research, so looking at kind of the economics of ag policy and what ag policy means for the choices that farmers have to make and get to make. And then 30% extension. And so that's kind of a lot of policy outreach, but also things a bit more kind of classic production economics, like the talk that I'm going to be sharing with you today. So I apologize. I think I owed Victor a title for the talk, and if I had done my job, it would have been something very boring, like grain storage economics, period. But someone came up with a much more creative name, which I think is great, because I'm going to talk about kind of a few different types of storage technologies and thinking about the conditions, the economic conditions under which they would potentially pencil out and potentially not. Originally from Michigan, and did my grad school out in California, and I'm now excited to be here. So yeah, thinking in and out of the bin, the economics of soybean storage. All right, so I'm gonna kind of spend a few minutes just recapping, what we might call kind of grain storage basics, just kind of fixing ideas of, what is the goal of storage from an economic standpoint? What are the cases when it would potentially, deliver real value? Going to look at a little bit of trends in storage capacity and some of the other factors, particularly in North Dakota, that have people, I think, thinking more about storage for soybeans than they might be in a typical year. Walk through kind of 4 storage options, storage technologies. Not going to go very deep in kind of the technical implementation of how you would, actually go about, procuring one of these and getting it installed. Going to focus more on kind of the economics. So kind of at a given capital cost and a given interest rate, what sort of technologies are potentially looking like a good choices, and then basically tying that to the beliefs that you have to have about kind of prices increasing over the winter. So, and then finally, I'm going to talk a bit about the North Dakota storage loan programs. So these are programs that were put in place last summer into the fall, offering essentially a subsidized interest rate on loans specifically for storage capacity in North Dakota. So I guess it's something, certainly if I was building new storage, I would look into these programs to determine my eligibility. All right, so I think one kind of mistake that a lot of economists can sometimes make, and I think I've felt prone to this in the past, is thinking about storage as purely marketing based. And indeed, most of my talk today is going to, really focus on kind of storage as a way to procure a better price for your product. But I think it's really important, like upfront, that we remember that storage also has operational implications, right? So this is a way to smooth labor that might be, you might have labor problems if things are kind of building up and you have to get everything to an elevator in just one day. Storage can smooth that. It can be a way more, more with corn potentially than with soy, but a way to take in grain at higher moistures and then dry kind of with more flexibility. So there's operational reasons to have storage and to use storage separate from what we might think of as kind of marketing reasons. So when I say marketing reasons, essentially this is kind of using storage for the purpose of hopefully procuring a better price for the product. So there's a few ways that could happen. Seasonal carry. So this is just futures price on a contract that's delivered in May, typically going to be higher than a contract that's delivered in November, just due to the timing of the harvest season. And then basis improvement. And I'll show one figure in a few slides that kind of highlights how important basis is in North Dakota in particular with respect to soybeans. And then flexibility. So, if you have soybeans stored, you can kind of look for opportunities to kind of jump on things and get a better price. I do want to kind of flag, I guess, or point out that some of the advantages that people discuss from a marketing standpoint are at their core speculative. And so what I mean by that is they're not always different than if, I just went out and bought soybeans on the market and in hopes that I would be able to sell them later. So there's ways to use grain marketing. I'm sure Frain will talk more about this to reduce your risk, and then there's ways to use it to increase your risk. So when you're using storage, you often want to think about pairing that with different types of contracts that make sure that the storage is reducing your risk, not increasing your exposure to price movements. Of course, unless that's what you want. So everyone is kind of entitled to their own opinion on how prices will move. But so for a lot of years, we saw really steady storage capacity just kind of keeping pace with crop production. So this is a nice figure produced by Joe Jansen at University of Illinois. And really starting in 2000, you see kind of they're almost moving up in perfect parallel, right? So the capacity that we have to store product is kind of the same as the capacity that we have to grow it, or at least they're moving kind of one for one up together. And that really stops around 2018. And I don't show the slides, but they break it out regionally, and it stops just about everywhere other than the Eastern Corn Belt, kind of right around the same time, where the data that the USDA collects on storage capacity really stops to grow, but crop production doesn't, right? So we're still kind of certainly up relative to a decade ago, even though the storage capacity has flattened out. And so a natural question then is, okay, well, why might that be happening? And what are the factors that people, need to think about when they think about, whether they want to buy storage or potentially, if they want to build storage. And obviously these are linked, right? If lots and lots of people want to buy commercial elevator space, then that makes kind of the economics of expanding a commercial elevator more feasible, right? So these are kind of linked economic choices that people are thinking through and making. So this is a very simple equation. I think there's lots of holes that could be poked in it, but I wanted to really kind of distill it to the core concept, which is that for storage, the price improvements that happen between when you put it in storage and when you get it out and sell it, they have to be larger than the cost of capital and the cost of storage. So those price improvements can be coming from the futures carry, so kind of an October to May future spread. And that's essentially the market at a national level basically telling you what it will pay for storage, right? Because that's if you have grain today and you want to have grain in May, there's really only one way to have it, which is to store it somewhere. So that's the closest thing that we have to kind of a market price of storage. But of course, that's at a national level. So kind of regionally or locality specific, there can be lots of changes. And then the second is basis narrowing. So, as we get further into the winter and then into the spring, a pretty common pattern is, the local cash prices will look more and more like that Chicago CME price. It never gets there, certainly not up here, but it gets closer and closer. So that's the price improvement side. And then we need to think about kind of the cost of capital. And I think it's easy to think about kind of building infrastructure as capital, but soybeans are also capital, right? So this is, if you have, a bushel of soybeans that you could sell today, but are choosing not to, you're obviously tying up resources that you could invest, could pay off a loan, could do any number of things. So as economists, we want to think about kind of the opportunity cost of that money. So even, and this is true even if you would have to sell below a cost of production, right? So kind of regardless of how bad the prices are, there's still an opportunity cost of kind of not selling today and having those resources available to pay off debt or invest. So a lot of times this is going to be larger, in fact, than the actual kind of what we might think of as the direct cost of storage, aeration, electricity, annualized capital, things like that. And then I've sort of lumped in, along with this cost of storage, in addition to kind of costs that are denoted in dollars, also kind of shrinkage or loss of quality. So, and this is going to differ, obviously, very much depending on exactly what type of storage technologies we're talking about. So just kind of at a really high level, that's how I think I want to kind of have people's minds framed about when storage would make sense. So when price improvements, when we have a reason to think that they're going to be really large, that would shift us more towards storage, and when interest rates are low, and when kind of we're not so worried about potentially weather, spoilage, or other things on the cost of storage side. So I think, obviously, I've only been here a year, so someone can feel free to correct me if I'm wrong, but I think that 2025 probably marked one of the years where someone with kind of corn and soy was most likely to try and sell corn off the combine and store soy. So normally it would typically be the other way around, just given kind of how prices would look around harvest. You'd be looking to store corn and selling soybeans kind of right away to clear out room. That was not so much the case this year. And I think, a big part of that was just how bad the soybean basis was. So I have a map here of basis rates. This is from DTN, who provides kind of county level basis information. You can go to their website. They post it publicly. It's just kind of a snapshot in time. So I grabbed this last October. And yeah, I mean, the red is bad. So that's, not what you want. And pretty much the entirety of North Dakota was in, really bad shape with respect to soybean basis. Different hypotheses for why this was, but, I think a pretty strong hypothesis is that this was kind of the point in time when the China export looked the most bleak. And it doesn't look, fantastic today even. I think Fran will talk more about that. But, at the time, China had taken almost none. So now they've taken some, but at the time they had almost none. And this is kind of the soybean market reflecting that. You see this, color gradient as you get kind of closer and closer to New Orleans and the Gulf of Mexico. It gets kind of greener and greener. Those are not going to China. Those are going to other destinations. But, up here, we like to rail it out to the Pacific Northwest. And when those export channels become not available, basis is really low. So what does that have to do with storage? I think, to put it simply, when basis is really, really low, people kind of have an intuition that it has to go up. Of course, that's not strictly true. Basis doesn't have to go up, but it's not a terrible theory. If basis is really, really bad, there's reason to think that we might see a bigger than usual increase across the winter. So that was, I think, part of the reason why we saw kind of more interest in storing soybeans than we typically would. Just hope that, things have kind of gotten as bad as they can, both with respect to basis and the futures price, and that the winter was going to bring kind of positive price movements for soybeans. So looking back historically, is this true, basically? Do we see stronger basis in the spring than we see in the fall? And the answer is pretty much yes, but potentially much smaller than you would need to have to actually pay off storage. So to be fair, I'm not including the futures market carry here. I'm only including the DTN basis data for each year. So you could reasonably think about adding maybe another 20 cents. Obviously, depends heavily on the year and depends heavily on whether you've hedged your soybeans or not. But just looking at the basis, we see pretty consistent, with a few exceptions of 10 to 20 to 30 cents strengthening in basis as we get through the winter. So this is a return to storage, basically. And so we want to be thinking about kind of what our expectations are with respect to this price when we think about what sort of storage options make sense. So, obviously, if we're in a crop year like 2021 and 2022, that would really move you against wanting to store. You're basically, just doing someone a free favor to give them soybeans at a time when it's even more valuable for them to turn and sell after you paid for all the storage costs. So better to just kind of get them out of the bin. Obviously people don't know kind of what's going to happen in the future when they have to make these decisions, which is why we look to historical averages like this. This is kind of a simple point in a simple simulation, but it just kind of goes to underscore how important the interest rate is. So this is just the cost of storing that you would pay in interest. So just interest, not including anything else. This is kind of just the interest that you would pay on beans that go in October and that get taken out in May. And you can see, it's totally mechanical. This is just, a simulated data. So it's not like a surprise that all the lines go up and they go up linearly. But if we look at kind of 8 months here, we're looking at a 4% interest rate. You're looking at 27 cents. If you double that up to an 8% interest rate, closer to what you probably would be looking at today, you're over 50 cents a bushel. And that's, again, before any kind of physical cost. That is just the interest cost. So you really have to have a pretty optimistic view of where prices are heading throughout the winter to justify a lot of storage at these higher interest rates. Again, kind of setting aside operational concerns. So I've sort of talked about the decision of whether or not to use storage, assuming that you kind of have access to some storage. And of course, you would probably have access to some sort of commercial elevator, although I know it was tight in some spots this past fall. A related decision is, when it makes sense to look to build new storage. And so I have kind of five options here. So the first two are kind of new construction, basically, that you would need to take out a loan to build. And then looking at kind of under what scenarios would that pay off? What scenarios wouldn't it? 3, grain bags is more of kind of a low capital, more kind of year-to-year temporary fix. And then comparing those to commercial elevator, and then just because I heard some people talking last fall about this, more for corn than for soy, but I included this temporary ring here, and we'll see, just based on the literature that's out there on spoilage, this is not something that's going to make a lot of sense for soybeans, but I kind of brought along for the ride here. So starting with kind of a brand new hopper. So this is, a really big capital investment. So if we bring back kind of all of the costs in the future, right? So this would be finance, right? So this would be, financed at a loan. So, talking about $250,000. If we bring that back to what it means in terms of every year of an annualized capital, it's looking at, $4.25 a bushel if we just kind of paid that today, right? So very, very expensive, but very high quality in terms of it can have potentially a really long lifespan. So, 30 years is kind of what people will say as a conservative estimate, but, obviously you can meet people and talk to people who have had, storage that's much older than that. So, it can go beyond that 30-year lifespan. And then I have here kind of extra shrink. So, obviously there's always some shrink. but this is kind of what additional shrink would you expect due to your storage choice. And with an investment like this, you kind of, if you're aerating it properly and managing it properly, you wouldn't be anticipating kind of any sort of additional shrink. And then labor is the other point, which is if labor is scarce, then this is kind of an option that's going to be more appealing because it's very low labor relative to a lot of other options. So shed conversion, this is kind of an option for people who have buildings on the farm that are not being utilized or not being kind of fully utilized, and basically trying to leverage that existing infrastructure to get kind of a good deal on storage, basically just trying to use things that are essentially free to you. I mean, again, we might talk about like an opportunity cost. If you're using a shed for storage, you can't use it for other things. But if it's sitting empty, then that opportunity cost is kind of pretty low. So here, a much more kind of feasible capital cost. So again, these are in present dollar units. So kind of the more that we ticked up the interest rate, the higher that dollar per bushel in capital cost would look. Not going to be the same type of lifespan as a new bin, and not going to have the same degree of labor savings. So if you kind of compare, if we just flip right back and then back, you can see 2 cents a bushel for a hopper, 4 cents a bushel for a shed conversion. So I mean, what's comprising that 2 cents? That's kind of all the labor of taking something out of a pile rather than letting gravity do the work for you. And then there is going to be a higher chance of moisture problems and surface crushing, and a lot of this depends on kind of what state the shed is in when it gets converted. So this could be higher, this could be lower. Really is kind of a case-to-case situation. So grain bags. So again, this is much basically zero capital, and this you would just use it for 1 year. So this is kind of when interest rates are really high, but storage is really valuable. So you can think about kind of when would that be? That would be when you're expecting a large increase in the winter price or in prices across the winter, and interest rates are really high. That might be a time when you would kind of think about deploying this type of strategy. So I pulled these cost estimates from a University of Tennessee extension report. So I haven't priced them out in North Dakota myself, so I can't 100% vouch for them, other than to say I kind of going through line by line, nothing jumped out as unreasonable. And when you kind of backcast that to a per bushel cost, you're only talking about 10 cents. But again, unlike the previous examples, this is 10 cents in 1 year, not something that's going to provide infrastructure for decades. Similar to the shed conversion on labor, you still have kind of a lot of the same issues, which is that ultimately you have to relocate this pile of grain from one location to another location, and you don't have kind of the benefit of gravity putting it right into how you're moving it. And even though the bags in theory should be kind of climate controlled, in practice things happen. So things don't get sealed properly. You have risk of wildlife trampling over things. So there is spoilage risk. And then, these are just kind of numbers. These were the bids these bids are a few months old at this point. So I collected these last fall. But just looking at, comparing these to, what if you just took it straight to a commercial elevator? I potentially should have included transport costs. Obviously, that's going to be very, very farm specific. So I haven't included kind of I haven't taken any stance on, which of these would ultimately lead to more or less transport. That's obviously something that's just going to kind of differ based on where you're located and where your elevators are. And then this is an idea that people kind of bounce around for corn. I think, I'm not saying I recommend it, but if you go online, you can find people who have, great testimonials. It really panned out for them. But it doesn't pan out for everyone. So, the cost is low. It's another kind of similar to a grain bag. You would think about this as like a really low cost, potential solution. The issue is that the shrinkage can really just be phenomenal. So, 1% is honestly, like probably optimistic. If you did this, year over year over year, I would expect you to average higher than that. So, NDSU has, it's a few years old now, but still a lot of good content in there, looking at alternative grain strategies. And their estimates are as high as 5% or even 10%, or higher for the spoilage, the kind of the additional spoilage that you would get deploying this strategy. So, once you're above 1%, it's just totally infeasible that the economics would pencil, and you'll see that on my next slide here. So these come from a range of either that NDSU alternative grain storage guide, or some tools put out by Iowa State and Minnesota Extension. Minnesota, they're probably pretty reliable. They face a lot of the same weather challenges we do up here. Obviously, North Dakota has unique challenges with the thaw freeze cycle that aren't going to be present farther south. So probably pretty much any number you see from Iowa, you'd maybe nudge it a little bit higher. So what happens when we kind of put all these costs together? So we have our upfront capital. Again, we don't want to use kind of a straight line depreciation, right? We want to think about this as, what if I had to procure a loan today that would kind of give me the financing that I would need to pay my payment on this infrastructure, out for the life until it was paid off. So it's going to be higher than if you just kind of, divided the upfront cost by the years you intended to use it. And that's because of the time cost of money, the interest rate, right? So these are based on a 7% interest rate. Assumptions on the useful life come from, again, a variety of kind of extension reports. I think these are certainly on the kind of new hopper bin. I think they're maybe a little on the pessimistic side, but probably, a large investment. You don't want to be too optimistic. So then when we kind of annualize these fixed costs, what do we get? And you see kind of a really, big difference here between kind of a new hopper bin and then kind of the shed conversion or the grain bags, right? So you're basically paying for, you're paying for a lot of things. One, you're paying for convenience. Just, things that are more convenient cost more money. And you're paying for labor flexibility, and you're paying for that kind of higher quality and less shrinkage and spoilage risk. And so kind of thinking about an eight month storage situation, so October to May, where does that kind of pencil out per bushel? Again, there's a lot of factors that are going to be farm specific here. But, they're kind of all in the ballpark of 90 cents to $1, except shed conversion. If you already have that infrastructure and it's not being leveraged, then you basically can kind of think of you as like getting 20 cents for free, basically, or basically paying that 20 cents through your own infrastructure that you own that you're kind of contributing to the storage goal. And then the tempering just, with pretty reasonable spoilage estimates, it just doesn't work for soybeans. So that's kind of quickly falls out of contention. So this is kind of a snapshot in time at one interest rate. But now I want to kind of consider a few different scenarios here. So I know this slide is a little bit on the busy side of things, so I'll kind of try and walk us through. So we're going to start on the left-hand side here. So up at the top, you'll see this 40 cents per bushel gross return. So this is the futures carry plus the improvement in basis. So this is a belief, basically. You would need to have some belief about what this would be on average in order to determine kind of whether a technology made sense or not. So this is probably a bit lower than the average that we've seen, but not by much. 60 cents per bushel is probably a bit above what we've seen. Again, obviously with future prices, they can be very volatile, especially thinking about kind of the war in Ukraine is kind of in that sample. So the specific days that things get bought and sold can really affect whether a storage strategy looks like it's working or looks like it's not. But we kind of don't want to fix too much on those outlier events because we really want to be able to have like a belief of like what's expected, what seems like a reasonable number. So that's these three scenarios. So 40 cents of improvement in basis plus futures carry from October to May, 60 cents, 80 cents. And then we have kind of an interest rate ranging down here on the bottom from 3% to 11%. And then this is kind of net return. So you can see at 40 cents of price improvement, again, setting aside operational concerns. Sorry, I know that's like the fourth time I've said that, but setting aside operational concerns, it's a bit challenging to justify versus kind of selling immediately. I mean, obviously, if there's cases where basis is so bad that people feel that they can't sell, but it's if you're only anticipating kind of a 40 cent per bushel improvement in prices, it's probably just better to get it sold. When we move to 60 cents per bushel, things start to look a lot closer. So, at these low interest rates, really all the technologies are close to penciling, and depending on certain context-specific situations on your farm, maybe, or if you tinkered with some of my numbers or said well, that maybe that's true in Iowa but not true here, you could easily imagine kind of those becoming positive. As we get out to where kind of market interest rates are today, around 7.5%, that's again hard to see if you're only anticipating kind of a 60 cents price improvement. Hard to see exactly how that would typically pencil. As we get kind of more optimistic, obviously, then things start to look quite good at many interest rates, or at least kind of near a break even. So related, it's sort of a pivot, but it's related because we've just saw kind of how important the interest rate is at determining at what technologies would potentially make sense. And now we're going to talk about programs to give people low interest rates on storage investments. So there's two programs that were put out by the Bank of North Dakota. So one is, I think, was originally really targeted at folks who were affected by the derecho last June, but has been expanded to other producers who can demonstrate an operating shortfall in the prior 2 years. And that's the Farm Financial Stability Loan Program. And there's, yeah, you would have to kind of go to their website to see all the potential exact uses, but storage is certainly something that, can be financed with these loans. And then the 2026 Grain Inventory Loan Program is more targeting kind of very short-term financing. So not having kind of the as low of an interest rate, and really kind of targeting kind of shorter investments. And both of these are going to be administered like through a local lender, but the Bank of North Dakota would basically fix the rate that could be charged. And what are those rates? So I'll kind of jump to the punchline, and then I'll back up. So for the grain inventory loan program, you're looking at a rate of 6.25%. So, certainly below market. And then for the farm financial stability, you're looking at an even lower rate of 4.75%. So that is, substantially below market. So if you have eligibility for that, and you have a need for financing, it's definitely something to look into. Plotted here are kind of the Bank of North Dakota's base rate, as well as from the Federal Reserve Bank surveys, just kind of an estimate of what fixed and variable loan market rates are. So, we can see things are kind of ticking down over the past 2 years, but still obviously, quite high relative to where they were a few years back. So, okay, with these numbers in mind, 4.75 and 6.25, if we just kind of like keep those in our head, and then go back here, again, I think when you look in this middle plot at 60 cents a bushel, and then you look at, we can just use the 5% line. That's where, really everything is kind of what we might think of as like in the ballpark of penciling. And then, shed conversion is certainly there. But even under like very subsidized interest rates, kind of very desirable interest rates, if you don't think there's going to be price improvements across the winter, it's just hard to justify storage, again, from a marketing standpoint. So I'm done a little early, but that's all that I have. So kind of key takeaways: operational uses of storage, marketing uses of storage. If we continue to see kind of limited export markets, I think more and more people will be thinking about kind of how and when and why to store soybeans versus kind of what is more typical, where it's most of the crop is sold in the fall. Storage doesn't always pencil. Even in cases where you're selling at a loss, it might be better to sell at a loss than to hold and sell at a worse loss later. That's just kind of reality. But there are cases where things can work, and whether it's a low tech option or a high tech option, a lot of that is just going to come down to the interest rate. With high interest rate is going to be pushing you more towards a lower tech option. Low interest rate, might make sense to pull the trigger on something kind of fancier with all the new bells and whistles. So thanks so much. Really sad that I didn't get out to Minot, but happy to have a chance to talk to you today.